Ladies and gentlemen, good day and welcome to Amber Enterprises India Limited Q4 and FY24 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jasbir Singh, Executive Chairman and CEO and Whole-Time Director of Amber Enterprises India Limited. Thank you and over to you, sir.
Hello and good morning everyone. On the call I am joined by Mr. Daljit Singh, Managing Director, Mr. Sudhir Goyal, our CFO, Mr. Sanjay Arora, Whole-Time Director of Ilgin Electronics and our Investor Relations Advisors SGA. We have uploaded our results presentation on the exchanges and I hope everybody had an opportunity to go through the same. FY23-24 has been a year of resilience and growth for Amber. And in this 1 year, we have strengthened our portfolio and market offerings with strategic diversifications to new growth segments. From a core RAC player, we have transitioned towards a diversified manufacturing company supported with multiple acquisitions and MOUs that we did during the year, further fortifying our positions in the markets. Amber with the DNA of manufacturing is completely aligned with this transformative journey and is scripting its role through localization and backward integration of consumer durables and its components, EMS and railway subsystem and mobility. I'll now take you through some highlights on the consumer durable division. Our journey, as you all know, it began from room air conditioner sector, initially focusing on window ACs, then expanding into split units, then inverters, later branching out into cassette air conditioners, ductables and higher tonnage package units. As the industry landscape evolved with majority of the customers looking to shift assembly businesses in-house, we quickly recognized the need to adapt our strategies accordingly and diversified our portfolio. Initially, this involved transitioning towards supplying components to RAC customers with the aim of maintaining our market share in this segment at around 27% in value terms. I am pleased to report that we have successfully upheld this share and are optimistic about sustaining it moving forward. Additionally, we expanded into supplying components of non-room AC applications such as telecom components, smart meter components, automobile components, refrigerator, washing machine, microwave components and more. As a result of this strategic shift, our contribution from room AC has decreased from 72% in FY18 to just 40% in FY24. As guided during previous call, our RAC top line was hit due to brands taking RAC assembly in-house and the reflection of the same is evident in our top line of FY24. This was a well-known transition and hence we diversified our offerings in the component space which are more margin accretive. Further, 2 more customers will begin their plant by next quarter and post that the business model will move towards stability and growth will move in tandem with the industry trend. Glad to share that due to high temperatures and good secondary sales in the month of April and May, we are moving with a run rate of 20% growth and expect the same growth by year end for this division. Also, our operating EBITDA margins in consumer durable division have increased by 100 basis points, touching to 7% now, which is reflective of our component strategy with better margins. I am also glad to share that Amber received a PLI grant of rupees 15 crores for manufacturing of AC components. On the JV with Resojet, continuing with the same thought process of strengthening our position in the consumer durable space, we have entered into 50-50 JV with Resojet Private Limited, part of the Radiant Group company, for manufacturing of fully automatic top and front load washing machines. This joint venture will propel Amber's diversification beyond air conditioners in finished goods into the washing machine and its component segment, thereby further solidifying our position within the consumer durable market. Mass production from the new plant will commence from H2, second half this year, where we expect around 40,000 washing machines to be produced in this year, which will further take it to 1,25,000 in next financial year. We have already onboarded a couple of customers and the trials are currently going on. Through this JV, we gain access to manufacturing washing machines, thereby allowing us to offer wider range of high quality products to our customers. Now I will take you through highlights on electronics division. In the past 5 years, our stint, which started from providing PCBA solution for inverter AC, has now diversified into providing solutions for home appliances, consumer electronics, wearable and wearable, telecom, smart meters and automobile segments. We have further amplified our offerings by making an entry into manufacturing of bare PCB, which going forward will open new avenues for us in the sector of aerospace, defense, medical electronics, EV, mobile and energy solutions, amongst others. We acquired 60% stake in SN Circuit for manufacturing of printed circuit boards, single-sided, double-sided, multi-layer and RF PCB. The company has been catering to marquee customers such as ISRO, Bell, BHEL, automotive component customers, telecom, consumer electronic clients, both multinational and domestic, who have been driving India's growth journey. This acquisition will enable us to offer solutions to applications such as aerospace and defense, medical, energy solutions, etc. This acquisition strengthens our EMS portfolio by enhancing our presence in passive components of PCB assemblies. This uniquely positions Amber as a leading player in the electronic EMS space. Further, our MOU with South Korea, Korea Circuit, through our recent venture SN Circuit for manufacturing of flex, HDI and semiconductor substrates, PCBs in India, will bolster Amber's electronics EMS play. This MOU will enhance the capability of SN Circuits for providing solutions to the mobile and semiconductor industry, which has been a focus of the government recently. This association between Amber and Korea Circuit will envelop the entire portfolio of PCBs required for various applications in India's electronic manufacturing growth story, that is HDI, flex, semiconductor substrate, multi-layer, double-layer, single-sided, etc. Also, the recent decision by government to impose anti-dumping duty on imported printed circuit boards will settle the dust of import and make the road clear for localization of bare boards in the country. In this electronic EMS division, we have traveled a journey from 3% EBITDA in 2018 to 5.6% in FY24. Now going forward, we are confident to touch EBITDA's range in the range of 7.5 to 8% for this division in the current year. On the railway subsystem and mobility division, as you all are aware that last year we expanded our portfolio from HVAC to doors and gangways through TOT with Ultimate Group and also added pantry systems in Sidwal. We are glad to share that during year of FY24, we received our first order for doors and gangways from 3 new customers. In phase 1, we shall assemble these new products, and in phase 2, complete manufacturing will begin from Q1 FY26 onwards. During the year, we did a strategic alliance with Sitagarh by investing in Firma in Italy and also did a JV with Yujin of South Korea for couplers, gears and pantographs. We are also glad to inform that our defense portfolio in Sidwal is gaining momentum. The order book for defense has moved double digit during this year, and we are expanding our product portfolios for specialized terrain vehicles, slip-on air conditioners, etc. For expanding our capacities, we have done a groundbreaking ceremony for our upcoming greenfield facility in Faridabad, and construction is in full swing. This new facility shall have state-of-art manufacturing facility for energy-efficient air conditioners, doors and gangways for railways and metros and pantry systems. We expect commencement of production from this facility in Q1 in next financial year. Another brownfield expansion will be done for Yujin products in the country in current financial year. We expect to receive all clearances and approvals from customers in FY26 and expect to commence production of Yujin products, that is couplers, pantographs and gearbox, by Q4 of FY26. With all the above mentioned initiatives, Sidwal can now give solution up to approximately 1.1 crore per passenger car which expands our addressable market multifold. FY25 shall be the year of execution and customer approvals for these new products, and the real ramp-up in revenue for all new product categories shall start from second half of FY26 onwards, which is in line to the rolling plan of new Vande Bharat Express trains. I shall now request Sudhir Goyal, our CFO, to take you through the consolidated financial highlights.
Hi, good morning everyone. So now I will take you to the consolidated highlights of the financials. So on the revenue front for financial year 24, revenue stood at 6729 crores compared to 6927 crores in financial year 23. We have reported revenue of rupees 2806 crores in quarter 4 financial year 24 versus revenue of rupees 3003 crores in quarter 4 financial year 23. Operating EBITDA for financial year 24 stood at rupees 519 crores versus 475 crores in financial year 23, a growth of 9% for quarter 4 financial year 24. Operating EBITDA stood at rupees 234 crores compared to rupees 204 crores in corresponding quarter last year. Operating EBITDA is before impact of ESOP expenses and other non-operating income and expenses. Operating EBITDA margin for financial year 24 stood at 7.7% versus 6.9% in the financial year 23. PAT for the financial year 24 stood at rupees 139 crores versus 164 crores in financial year 23. For quarter 4 financial year 24, PAT stood at rupees 99 crores versus 108 crores in quarter 4 financial year 23. Net debt for March 24 stood at rupees 615 crores from rupees 588 crores in the March 2023. Working capital days for March 24 stood at 13 days as compared to 29 days in March 23. Overall CapEx for financial year 24 stood at rupees 373 crores compared to rupees 698 crores in financial year 23. We plan to incur CapEx of rupees 350 to 375 crores for financial year 25. Due to the anti-dumping duty imposition on the printed circuit boards, new venues of opportunities are opening up and expect marquee customer addition in auto and IT related product category and consumer durables. We are evaluating our expansion plan for the printed circuit board for Make in India and shall inform once a decision of total capacity expansion has been taken considering all the government incentives in place. Coming to the divisional highlights, we shall now take you through all the 3 divisional highlights which are as follows. The consumer durable division has reported total revenue of rupees 5,009 crores for financial year 24 compared to 5380 crores in financial year 23. For quarter 4 financial year 24, revenue stood at rupees 2199 crores compared to 2475 crores in quarter 4 financial year 23. The operating EBITDA stood at rupees 352 crores in financial year 24 versus rupees 325 crores in financial year 23. The operating EBITDA in quarter 4 stood at rupees 179 crores compared to rupees 156 crores in quarter 4 financial year 23. We expect margin expansion in this division due to our shift of strategy towards components and further diversifying into manufacturing of fully automatic top load and front load washing machines and its components. We expect to maintain our share of business of around 27% of manufacturing footprint in value terms in our RAC division. The electronic division has reported total revenue of rupees 1241 crores for financial year 24 compared to rupees 1125 crores in financial year 23. For quarter 4 financial year 24, revenue stood at rupees 484 crores compared to rupees 415 crores in quarter 4 financial year 23. The operating EBITDA stood at 69 crores in financial year 24 versus 51 crores in financial year 23. The operating EBITDA in quarter 4 financial year 24 stood at 33 crores compared to 21 crores in quarter 4 financial year 23. With marquee development during the year such as customer addition in telecom, automobile and durable space, onboarding large smart metering business and customers in automotive segments. LG entering JV with Nextbase for manufacturing smart variables, acquisition of Ascent Circuit for expanding portfolio into PCB boards for various applications, and Ascent signing MOU with Korea Circuit to manufacture Flex, HDI, semiconductor substrate PCBs. With such developments, we expect this division to increase its margin going forward. We are targeting an EBITDA margin in the range of 7.5% to 8%. And expect this division to grow by above 35% in the current financial year 25. The Railway Subsystem and Mobility Division has reported total revenue of rupees 480 crores for financial year 24 compared to rupees 422 crores in financial year 23. For quarter 4 financial year 24, revenue stood at rupees 123 crores compared to rupees 113 crores in quarter 4 financial year 23. The operating EBITDA stood at rupees 98 crores in financial year 24 versus 99 crores in financial year 24. The operating EBITDA in quarter 4 financial year 24 stood at rupees 22 crores compared to rupees 28 crores in quarter 4 financial year 23. Just to reiterate for the benefit of all, our Railway Subsystem and Mobility Division has witnessed remarkable developments during the year with manufacturing air conditioner system for the Namo Bharat trains, Sidwal strategic partnership with Titagarh Rail Systems, and now with 80 Rail Subsystems JV with Eugene Machinery. These developments places Amber Group in a sweet spot to increase its wallet share and BOM per passenger coach, which is in line with our strategy. Further, we have received our first order for new category added in financial year 24, that is doors and gangways. Glad to share that new order for doors and gangways received from 3 customers amounting to rupees 515 crores. This makes total order book of Sidwal at approximately 2,000 crores. With good order book in place, increase in product offering per passenger coach, and Sidwal getting a preferred supplier status, we expect Railway Subsystem and Mobility Division to double its revenue in the next 2 to 3 financial years. With all the initiatives in respective divisions, we have established a robust foundation for strong growth over the next decade. We expect further margin improvement in this current financial year at a console level by at least 50 basis points to 75 basis points, and hence ROC level to bounce back above 15% in financial year 25. With this, I would now open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question will press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking the question. Ladies and gentlemen, in the interest of time and fairness to all the participants, each participant will be allowed 2 questions. If participants still have more questions, they can rejoin the queue. Ladies and gentlemen, we'll wait for the moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Avendus Spark. Please go ahead.
Hi sir, thanks for taking my question. My first question is with respect to the railway business. There seems to be a lot of exciting opportunity over there, and you are also increasing your capability in that. Just wanted to get your sense with respect to Sidwal. How is the opportunity that we need to think of with respect to the traditional railways, the Vande Bharat trains? Defense also you had mentioned there's a bit of opportunity, and there has been a lot of work going on in data centers also. What can be the addressable market over the next 2-3 years that you can talk about? And with respect to the Titagarh joint venture, would we be addressing the opportunity of Vande Bharat only from the Titagarh angle, or will we be in a position to supply to other Vande Bharat manufacturers also, train manufacturers also? If you can give your broad thought process.
Yeah, good morning, Ravi. Basically, this modernization program which was kicked in by Government of India for complete railway ecosystem, which includes new Vande Bharat Express and also urban mobility, where new cities are getting new metro lines and the existing metro lines are also getting expanded. This opens up a wide multifold business opportunity for a company like Sidwal. I give you just a brief data number. As per the recent media reports published by Ministry of Railway, they are now coming up with a grand plan of almost about 3,000 new Vande Bharat Expresses to be rolled on in next 5 to 6 years. Now, new Vande Bharat Express will have 24 coaches. These are sleeper coaches in one Vande Bharat Express. So that means almost about 72,000 coaches, passenger cars will be required to be delivered in next 5 to 6 years. And as a Sidwal, on a comprehensive solution provider, at what level we have become supplying almost 7 components what goes into passenger car, addressing almost 1.1 crore per car. So that is only opportunity of Vande Bharat I am talking to you currently, which is going to come in next 5 to 6 years. And also to clear, there are almost close to about 550 to 600 coaches which are required in the metro space also. Every year metro lines are expanding. That business is also expanding. And we have clearances from all customers who are giving rolling stock to metro divisions like Alstom. They are all our customer. Bemal is our customer. Titagarh, of course, has become our customer, and new customers like TMH and Siemens and all, they are also been onboarded. So we are not, yes, with Titagarh, we have a preferred supplier status for, as a partner with them. But we are free to deliver the solutions to everybody, and we are receiving this order book from other companies also. So that is what. So we are very excited with this capability enhancement which we have done. This has been very strategic move. I think post current year of FY25, where all the new factory will be put up, plus the new customer approval will be coming in. Order book has already started flowing in for the new product categories, and we are excited for this journey going forward.
Understood. And all these products will we be manufacturing here, pantry, doors, gangways, couplers, or will there be a sourcing strategy for this?
So all these will be manufactured here only in India. We have one factory in Faridabad. Second factory groundbreaking ceremony has been done. The construction is in full swing. The Eugene products, which are the gear, couplers, and pantograph, that team is yet to come from Korea, and once they come, we will finalize the location. And once the location is finalized, then we'll go ahead with the creating the factory for those products also.
Understood. And with respect to...
Sorry to interrupt, sir. I just request you to rejoin the queue for the following question, please. Yeah, thank you. The next question is from the line of Natasha Jain from Nirmal Bang. Please go ahead.
Thank you for the opportunity, and good morning, everyone. So first off, it's encouraging to see that our RAC will truly started playing out. So congratulations on that. So my question firstly is on the reported numbers. So in your segmental numbers in the PPT versus what you've published, especially at EBIT level for electronics, there's a very stark difference. So on the published number, I think there is a degrowth of almost 470 basis points, and on the PPT there is an increase of 170 basis points. So if you can tell us what's the difference here, because even if I take full impact of ESOP, there is still a decline. So if you could call out what are these non-operating income and expenses. And secondly, on that segment again, we see tepid growth in FY24. Now our guidance have been that we want to clock in 50% top line CAGR. So like how you explained for, Sidwal, if you could tell us the strategy here also going forward, how can we get back on that growth path? Thank you, sir.
So basically on the growth part, like PCBAs, we have already expanded our applications. We are no more a consumer durable application company. We are now giving application solutions for telecom industry, for hearable wearables, for smart meters, for auto players also. And plus, we have by acquisition of Ascent Circuits, which is largely into defense, aerospace, and predominantly into auto space. This expands our portfolio of offering both into PCB as well as PCBA world. And that's how, we are very confident of achieving, because our PCB business is at a higher margin as compared to our PCBA business. But on a blended basis, now we are targeting to touch 7.5 to 8% in this current financial year. As far as on the other income and concern, I would request Sudeep to answer that question.
Hi, good morning. So on the operating EBITDA, which you mentioned that there is a difference in unit division-wise performance versus the console. So if you see at console level, operating EBITDA margin is 7.7%. And on the divisional front, like consumer durable division is having 7%, electronic division is having 5.6% operating EBITDA margin, and railway substation is having 20.4%. So weighted average is coming to 7.7%. if there is some more differences coming, we can have a separate call and I'll discuss with you and give you the proper explanation. On the operating EBITDA adjustments, so one is the ESOP, which is totaling to around 17.7 crores. Then we have one fixed asset return off, because fixed asset gain on the sale of fixed asset comes in the other income, but loss is coming in the other expenses, so that we have netted off, amounting to around 8.5 crores, which is including put call option adjustment on the acquisition. And these are the major differences which will make it to the operating EBITDA level from the normal EBITDA.
Understood. So thank you. I have more questions, but I'll get back in with you.
Sure. Thank you.
Thank you. The next question is from the line of Dhruv Jain from Analysts Capital. Please go ahead.
Good morning, sir. So, sir, first question was on the working capital side, right? So we've seen a very sharp improvement in working capital. So just wanted to understand the sustainability of the same. Do you expect that the working capital will now normalize to the 13 to 15 days kind of number?
Yeah. So this is not a normalized level of 13 days. Those are normalized level in the year-end level. We are expecting it should be in the range of 20 to 25 days. But this year, because of some new customers we onboarded, we have a better term and we got the payment on time. So that helps us to reduce the payment term plus increase in the payment term of the creditors.
Okay. So second question was on the industry side, right? So, in the last 1.5 years, we have seen that there has been a lot of capacity put up by brands and EMS partners. So, there was that risk of insourcing, for various EMS partners. However, we've seen this summer being very strong. So, where are we in terms of the demand and supply, in terms of the capacity or the capacity utilization of the AC industry as such? Do you expect that the risk that was thought to be, say, for 2 years or 3 years in terms of lower RAC sales could actually play out earlier?
Well, Dhruv, basically, these are all recent units, manufacturing plants which have been put up by various brands. And whenever a brand puts up a factory, they plan longer for the capacities. And I think, yes, this season has been a very positive season. So capacity utilization will increase much beyond. I mean, we were not expecting this, but if we see from a long-term perspective, you may be right that in case these kind of trend of good season continues, then maybe the capacity utilization gets over in next 2 to 3 years only. But we have mitigated 2 large risks in our business model. One is, since we are supplying to the entire industry, so brands exchanging market shares do not impact us. And second, basically on the insourcing and outsourcing function, which is beyond our control, which is decided by the brands themselves. They keep on calculating between make versus buy. But good part is that we as a solution provider, we are also enjoying the good seasons, and we have seen good uptake both in finished goods as well as in our component division. I think we are already in April and May month, we are 20% plus at run rate of that. And if the Q4 also have a good season, probably industry will see in 20 to 25% range improvement in the whole industry level.
Thank you so much, sir. I have more questions. I'll get back in with you.
Thank you. The next question is from the line of Analysts from Jefferies. Please go ahead.
Good morning, sir, and congratulations on this continued diversification into niche components. So my first question is regarding the multiple new product stories and the tie-ups that you have recently entered. So the opportunity of each of these components is different, and each of these will accrue to your top line in FY25. So any kind of ballpark guidance in terms of revenue you would like to give? And also in Sidwal, what percentage of your overall top line do you expect Sidwal to come through in the next 3 to 4 years?
On a guidance, I mean, since all these 3 divisions are on a growth path, I think it's very difficult to predict how which division will contribute how much in the full financial year. But yes, we are seeing positive uptake in each division. I think electronics is on a growth path of delivering about 30-35% range on the top line basis. And also margin expansion, we expect it to touch to 7.5 to 8% this year. On Sidwal level, as Sidwal business is actually linked with the rolling of new Vande Bharat Express. So if you see all the order book which Indian Railways has given for Vande Bharat Express, so this financial year there are very less trains which are rolling out. But next year the number of trains are exponentially increasing. And FY27 is the peak year where, it's exponential increase in the number of trains which will be rolled out from all the customers, all the, rolling stock companies. So our business is also, we expect Sidwal to grow in that range only. As far as right now is concerned, we have got good order book. Our defense order book, which used to be earlier at generally about 20-25 crore, has always, all of a sudden we have shifted to 70 crores. And we are expecting that in line. And if the more we are adding some more products also for the defense offering. In metro space also the same kind of about 10 to 15% growth is coming. And on the consumer durable side, as I explained, we are running with a run rate of 20% right now. So on a blended basis, it's very difficult to guide right now on the top line. But yes, we should expect a good growth on the and good bottom line growth on a console level.
Got it, sir. So secondly, on your project, you did mention 40,000 washing machines in F25. Any customers names you would like to give at this point in time in terms of onboarding or prospective onboarding? And secondly, it's a JV. So what kind of numbers do you expect to accrue to Amber in FY25 or going ahead?
So it's basically a PAT which will be consolidated. Top line will not be consolidated in the control balance sheet because it's a 50-50 JV. On the 40,000 numbers have been, that's what we are aiming to deliver with the clients which have been already onboarded, for which the approvals are right now going on. I cannot name all the clients because we have NDA signed with them, but these are mix of multinationals, domestic and online players. And I think this will start contributing significantly after 2 years in the PAT levels also. But it's a good growth story. The assembly line has been put up already. The products have started rolling out. We have started giving samples to customers. Customers have visited our facilities. We have now onboarded almost about 4 customers, and we expect to add 3 more customers going in this year.
Got it. Sir, last question from my side. Any pricing actions you have taken in Q1, especially in your RAC business, or expected to take?
Price increases? I mean, since there is hardly any movement fluctuations of commodity side. Yeah, but only the copper is a commodity which is skyrocketing right now. The LME is shot up to that, which will definitely on a quarterly lag basis, as we have done in past, it will be done.
Understood, sir. Thank you. All the best.
Thank you, Sonali.
Thank you. The next question is from the line of Bhumika Nair from DAM Capital. Please go ahead.
Yeah, good morning, sir. So a couple of questions. One on the electronics side. For the quarter, have we included Ascent as well for fourth quarter, given that you acquired?
Bhumika, yeah. So it's only 2 months of revenue which has been added, which is 43 crores, which has been added in this financial year, FY24.
43 crore of revenues, and how much would be the corresponding EBITDA?
EBITDA will be 5.8 crores.
Okay. Got it. So now, if you can just talk about, how you did speak about a lot of demand and, favorable import duty, which will help Ascent grow. How do you expect this business to really pan out into FY25, 26? And how should we pencil in the growth when you're talking about 25% growth for the segment? I'm assuming this is excluding the Ascent business. Would that be a fair statement to make?
No, Bhumika, this will be including the Ascent business, but Ascent on its own as a company is witnessing a huge flow of customers and inquiries because of the anti-dumping duties. And anti-dumping duties imposed is till 6th layer of PCB, which is generally applications are basically automobile, IT and consumer durables. And already very big auto companies, large four-wheeler companies have started visiting, they're auditing. Their process is to audit and then approve is about 6 to 8 months time which they take. That process has started with almost 5 customers. And if I consolidate their demand of 5 customers, this company has a potential to grow by 100% next year. But it will all depend because we want to expand the capacities in line to the government incentives. There are spec scheme which is available and there is state incentives. So almost about 45% we will get back. So right now, we are taking inputs from everybody. We are also meeting government in Ministry of Electronics and IT officials for clarifying us on the spec scheme. And once the clarification comes and the customers' commitments are onboarded, then definitely we will roll on. But yes, we have a plan to bring up India's largest PCB manufacturing plant for Essence. Timing is very difficult to predict right now because it will all depend on the government incentives. So we will move in line to that.
So, and one correction here that like sir has said, operating EBITDA of Ascent for 2 months is 7.1 crores instead of 5.8 crores.
Okay, got it. So here in the electronic segment itself, right, I mean 70% is really the consumer durable segment. Within that, is it possible to understand how is RAC as a percentage of this electronic segment?
Out of that 70%, almost 30% will be RAC. 25 to 30% will be RAC.
Understood. So the last question is...
Sorry to interrupt, ma'am.
I'll come back to you. Okay, thank you.
Thank you. The next question is from the line of Rahul Gajaria from Haitong Securities. Please go ahead.
Yeah, hi.
I'm sorry.
Rahul, you are not audible.
Yeah. Can you hear me now?
Very bleak. I mean, there is some disturbance in your voice.
Okay, I hope this is better.
This is much better, yeah.
Right. Good morning and thanks for the opportunity, sir. So I've got 2 questions. One is on financials and one is on a slightly longer time frame. Now, last year, in FY24, we had an EBITDA of almost 500 crore rupees. And we landed up booking almost 70% of that cost or, expense under depreciation and interest. And this number has actually increased in the last couple of years, So I think that number was holding around 50-55%, and that has gone to almost 70%. With newer ventures and with more capex that is, lined up, this number is, I would think, will increase, at least on the depreciation side. Now, you understand this is certainly not good from a long-term perspective. How do you intend to manage your financials, over the next, say, 3 to 5 years? So that's the first question.
Yeah, so on the EBITDA front, like you said, in the last year, it was 470 crores, including the other income, not the 500 crores. And operating EBITDA was 475 crores, which is excluding the other income and the non-operating expenses. Plus, ESOP we have not included in the while calculating operating EBITDA. And this year, that 470 crores has become 547 crores. Percentage has improved from 6.79% to 8.13%. And the operating EBITDA, as apple-to-apple comparison from 475, it has come to 519 crores. Yes, on the depreciation front and the interest, there is a big jump in both the expenditure because of the growth prospects which we are looking into all the 3 divisions. That is contributing big in the current financial year and the last financial year. It is going at the same level because of the it definitely will not get reduced in the near future. But interest, we are targeting that it will not increase substantially in the current financial year and will be moving towards more profitability in the coming current financial and the future financial years. And margins are improving because of our component strategy, and PAT will also improve substantially in the current year as well as in the future years.
Okay, so that is likely to remain high, is what you're saying.
Depreciation, yes. But interest will this year.
No, I'm looking at these numbers, as a percentage of EBITDA, because, whatever operating profit, you may include ESOP or other things. It's just a very high number, basically. That I just wanted to understand your thought process over the next 3 to 5 years is what I was saying. Fair enough. So it's going to be slightly higher for the next couple of years. So my second question is, now this company has diversified, significantly over the last couple of years, from electronics to train subsystems, including several MOUs, stakes in company. How do you intend to manage all these activities? Do you have business head for this? And, what are the parameters, you as an MD would be looking for, as far as performance of these JVs, MOU entities is concerned? That's my last question. Thank
So
you.
it's all led by professionals at each level. We have a division who's CEO who's heading the RAC division. Then we have components division CEO. Electronics division CEO is right now sitting with us, Mr. Sanjay Arora. And mobility is headed by Udayveer, who's not on the call today, but yes. So everybody, they are growing the product portfolio, they are adding customers profile, they are increasing the wallet share within the existing customers and also increasing the geography profile of each division. And they're all basically all these JVs and MOUs have been triggered by them only. I mean, I was just the catalyst of going and signing the agreements largely. But it's all come from them because every division is excited for their own growth path. So it's a 3 themes which we are working on. Consumption theme is what consumer durable business is. Electronics theme is what we all know about EMS. And the infra theme, which is led by the government initiatives on the infra spending for railways and defense sector.
Okay. And, this CapEx that you've done last year, that was some 370 odd crore rupees. Sure, I'll get back to the question.
Thank you. The next question is from the line of Anupam Goswami from Trendlyne. Please go ahead.
Hi, sir. So my first question on the Sidwal, when you're saying that you are going to expand Sidwal's portfolio and venturing into new railways and segments, do you intend to keep the margins also? Do the margin will stay the same? How Sidwal has produced a little higher on the 23% margin? Because we have seen some margin dilution coming in this quarter as well as the ROCE.
No, margins actually for HVAC will continue to remain in this flat space. But as we add new product categories like doors and gangways, there are slightly little margins of 18% kind of thing. And couplers and gears and pantograph are also in the range of 18 to 19%. So we expect a blended basis, I think about 18 to 20% margin for the Sidwal products.
Okay, sir. And sir, you told about consumer or RACs or consumer durables growing at a 15-20%. Do we say this even at when brands are putting up their own factories? How do we, if you can share some light on this, how do we expect to grow at such a rate?
So brands have already put up their factories, capacities have been created, and we shifted our strategies for supplying more components to brand rather than finished goods. And that's why there was a structural shift in our business model, which is now getting settled. Because most of the plants have started at the brand level and 2 more plants are yet to start, which I expect in next quarter or so, those plants will also start. Post that, we will be supplying both finished goods and the components. So we have given this flexibility to brands. As of now, we are maintaining our 27% market share on the manufacturing footprint of complete room AC sector. So it doesn't matter to us whether we supply full air conditioner or a semi-knockdown air conditioner or just the components out of it. What we as a B2B company focus on is how deeply penetrated we are in each of the brands and are we having a substantial share of business in the whole industry as such. And we expect this industry to keep on growing in double-digit growth at least for next 10 years.
Just related to this, what explains the YOY degrown in consumer durables this quarter?
So we answered that in our commentary, but I'll reiterate that. It was largely we told that in last that next 4 quarters will be little shaky for the top line kind of a growth because the brands have taken in-house. So on the top line, brands have, because of finished goods going less, the top line has got impacted. And we were also impacted by Q1 unseasonal rains. So these are the two factors why the top line has come down, but margin improvement has come because of the component strategy and other product mix of the other divisions.
Okay, sir. Thanks, sir. I'll join back.
Thank you. The next question is from the line of Pulkit Patni from Goldman. Please go ahead.
Yes, sir. Thank you for taking my questions. So the first one is, in continuation of the previous participant asked, because while you haven't grown the top line much on the consumer durable side, you're saying 27% market share in AC components is maintained. So it should have reflected in our electronics division, right? Because part of electronics is also AC related. I'm not sure why that 27% is not reflecting in the growth for this segment. Or have we actually, on an overall basis, lost market share in the AC segment? That's the first question.
No, if you see the total addressable market of air conditioners last year, earlier Q1 was a dampener because of this unseasonal rains, and that's when we had predicted that industry will grow by 7 to 8%, but it has grown more than that, in about 10% range. And the numbers of the whole finished goods have come to about 9.3 or 9.5 million numbers. And if you convert them into numbers and versus what Amber has delivered in the RAC and RAT components, we are maintaining the share of 27%. So that's nothing has changed on that. But yes, it is not getting reflected because we are not selling more air conditioners. So we are selling largely components. And in air conditioners, we had passed through with us because compressors and refrigerants, other things get passed through which we are not producing, which were supplied largely by the brands to us. So that's not happening right now. That's the reason why it is not getting reflected. But the right way to look at the reflection is from the margin perspective. If we were not maintaining our 27%, we wouldn't have delivered this kind of margin and the percentage of EBITDA wouldn't have improved.
Sir, I'll have to understand that better because I think top line is where the market share should reflect. So anyways, I'll move to the next question. Sir, you have been talking about a 30-35% EBITDA growth for the company over 2 to 3 years, and it hasn't come through. So now that you have given some guidance in some of the sectors, are those numbers more like aspirational numbers or we have clear visibility? For example, in the electronics division, 35% growth and 7.5% margin. Is that something that is part of our order book or is that part of our aspiration that we want to get there?
No, we've never, told our aspirations. I mean, aspirations are of course to do 100% growth every year. But yes, I mean, this 7.5% is because of the blend of our strategy of PCB and PCBA business. Our PCBA business today stands at about 5% odd, and our PCB business stands at about 18 to 20% range. So that is the blend why we are confident of achieving 7.5 to 8% range of the console electronic division bottom line number. And that's what if you see all the electronic EMS who are delivering to defense, aerospace or industrials, they have better margins and that's what we've done. So we have shifted our strategies towards the better margin businesses.
Sure, sir. Thank you so much.
Thank you. The next question is from the line of K.U. Pandya from ICICI Life Insurance. Please go ahead.
Thank you for the opportunity. Sir, just one clarification. The 35% kind of guidance that you have given for the electronic segment, now 1240 crore of revenue for FY24, organically probably around 1200 crore excluding Ascent. So we are guiding for 35% growth on this 1240 crore revenue, which will include around 250 or 300 crore of revenue from the consolidation of Ascent as well, and which gives us organic growth of 10 to 15%. Is that a correct understanding?
Yes, that's a correct understanding. Our PCBA business and Ascent Circuit put together will deliver us 35%. So we expect this to come in the range of close to about 1800 crores this year.
Okay. And just one follow-up. So with all the diversification, away from AC. I mean, is there any macro reason why organic growth we expect to be lower than what we used to be in the last 2 or 3 years? Is it base or is it some macro challenge? If you can just throw some light.
No. Since our B2B segment in the contract manufacturing space has undergone a structural shift because of brands taking assembly in-house. So that assembly, the top line is not coming, and that's the reason we are not guiding any number. All what we are saying is that April and May, because of good season, is delivering. We are moving at a run rate of 20%, and if this trend continues, the industry grows by 20%, we will definitely grow by 20%.
I was just talking about the electronic segment. The organic growth of 10 to 12%, excluding Ascent consolidation. Is there any company specific reason or there is macro challenge?
Organic, there is a little slight understanding here because we were earlier manufacturing noise products in ILJIN. Now those products worth of about 400 crores will shift to the new JV. So we are not including that. If we totally talk about the electronics part, it will be close to about 35% growth for ILJIN and noise, and this is without noise. If we add the noise JV, that will be another 450 odd crores plus. So it will be total of 2200 crores.
Okay, understood. Point taken. The second and last question, the kind of diversification that we are doing and adding capabilities and the size that we are increasing, from the OpEx perspective or especially from the employee cost perspective, should we see just normal increase that we see, say 10-12% kind of growth, or because of the talent acquisition, that growth should remain higher for next couple of years?
No, it should remain normal because we've already done the JVs and all. The new factories which are getting which we have planned basically will bring us new revenue also. So it should be in the range. I mean, not exponentially high.
Understood. I will get back in with you. Thanks a lot and all the very best.
Thank you.
Thank you. The next question is from the line of Natasha Jain from Nirmal Bang. Please go ahead.
Yeah, thank you for the follow-up. So I have one question on the financials.
Natasha, you need to be louder.
Yeah, am I audible now, sir? Yeah. So my question is on your cash flow. So if I see your cash flow in FY24, there is a very big jump in loans to related parties. Can you just give a little color as to what these related parties are and why has it increased so substantially?
So, we have given a loan to related parties, especially one is 310 crore of our OFCD, which we have given to ILJIN from Amber to acquire Ascent. That is a larger jump, if you have seen. And it is now on 30th of April, it has been converted into equity shares. And earlier we used to have 70% of ILJIN holding. Now after that conversion, we are holding 85.6% in ILJIN.
Okay. Understood. Thank you so much.
Thank you.
Thank you. As that was the last question, I now hand the conference over to Mr. Jasdeep Singh for closing comments. Over to you, sir.
Thank you everyone for joining on the call. I hope we have been able to address all your queries. For any further information, please get in touch with Rohit or Strategic Growth Advisor, our Investor Relations Advisor. And have a good day ahead. Thank you very much.
Thank you. On behalf of Amber Enterprises India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.